Alright, let's talk about Zimbabwe's wild economic experiment. Picture this, a country that once printed banknotes worth $100 trillion just to buy a loaf of bread, is now trying to stabilize its currency by buying gold. But here's the twist: this week, the government just slammed the brakes on that plan with a $300 million spending cap. Why? Let me break down why this move feels like a high-stakes poker game where everyone's betting on gold, and no one's sure if the house will crash again. So first off, Zimbabwe's new ZiG currency, launched in 2024, is supposedly backed by gold. Sounds solid, right? Except when you dig deeper, this isn't Switzerland we're talking about. This is a country that defaulted on its debts in 1999 and has been locked out of global financial markets for 25 years. The IMF is basically watching this experiment like a hawk, and their recent 10-month agreement with Zimbabwe? That's less about trust and more about giving them a probation period to prove they won't mess up again. Personally, I think this $300 million cap is the IMF's way of saying, show us you can play with gold without burning the house down. Now, here's the paradox: Zimbabwe's gold production is actually rising. They mined 21.4 tons in early 2026, a 69% revenue jump to $3.1 billion. So why cap spending on the program that's supposedly propping up their currency? What many people don't realize is that this gold buying scheme isn't just about stability, it's a gamble. If gold prices crash, Zimbabwe's gold-backed currency becomes a magic trick with no rabbit. And if they keep printing money to buy gold? They're right back to hyperinflation hell. This isn't just fiscal policy, it's a tightrope walk over a volcano. Let me connect this to a bigger pattern. Zimbabwe's entire strategy feels like a desperate remix of historical fixes. Countries like Italy in the 1980s tried commodity-backed currencies, failed. Venezuela did oil-backed crypto, disaster. So why does Zimbabwe think gold will be different? One thing that immediately stands out is desperation. They're not just stabilizing a currency, they're trying to rebuild trust in a financial system that's been broken for decades. The $300 million cap isn't just a budget line, it's a psychological barrier. Cross it, and investors might flee. Stay under it, and maybe, just maybe, they convince the world they've learned from their past. But here's the deeper question: is this even about money anymore? From my perspective, Zimbabwe's playing a geopolitical chess match. By rebuilding ties with the IMF and pushing this gold scheme, they're trying to signal, we're responsible now, while quietly keeping their authoritarian tendencies intact. The 2027 budget review isn't just about numbers, it's about whether the West buys into this new narrative. And if you take a step back, this $300 million cap is less about economics and more about theater. A performance to convince global lenders that Zimbabwe won't repeat the Mugabe-era disasters. So what's next? If you're an investor, you're probably watching gold prices like a hawk. If you're a Zimbabwean citizen, you're stuck hoping this experiment doesn't collapse like the last 20 currencies they've used. What this really suggests is that no amount of gold can fix systemic corruption or mismanagement. The cap might slow the bleeding, but until they address the root issues, the ZiG might as well be monopoly money. And that's the real story here: you can't back a currency with gold if you don't have the institutions to back yourself.